Welcome back, best ever listeners, to the Horizon Podcast. I'm John Chang, and I've been active in real estate investing most of my life. And since 2007, I've led the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, as I do every week, I must mention that I am doing this podcast independently, and what I say on this show doesn't reflect the opinions or positions of Marcus and Millichap. So with all that said, let's dig in. So let's see here. Last week, we got the new inflation numbers, and basically the tariffs don't show up in the inflation numbers yet. So it's going to take time. We're seeing a little bit of inflation out there. It bumped up 10 basis points for the headline inflation number. But the reality of it is that we're not going to see the impact of the tariffs on inflation probably until August or September. And so I know a lot of people think that this would come up faster, but it's just going to take time. Remember that a lot of businesses loaded up their warehouses as the tariffs were coming so they could get ahead of the tariffs. So we're still going to burn through that inventory. In addition, it's just going to take time for the readings of all of this data to catch up with those tariffs and their impact on pricing. So don't hold your breath. This is going to take a little bit of time. So, really just set that aside. The consensus pretty much everywhere is that they will come through and we will see that impact. We are seeing a little bit of it. Some appliances went up, I think, 4.3% on a month over month basis. So we are starting to see it in isolated cases. But in general, we're not seeing really any price movement or outside of normal, right? 2.4% type of inflation, which is what we've been seeing for several months now. So we probably won't see the impact on that for a while. And so as a result, the Federal Reserve is going to keep holding their fire. They're going to hold on to interest rates where they are. They're not going to move up. They're not going to move down. We'll probably see them hold rates pretty much through the end of third quarter, more than likely through September. We may see a movement by the Federal Reserve in the fourth quarter, but that is going to be dependent on two things. One, what happens with inflation, and two, what happens with the economy. And so I think that recession risk is still out there, although a lot of the economists are starting to back away from that position. But it is still a risk. And the inflation is pretty much, there's still a broad consensus that we will see inflation at some point. And so that's where we see that going. In terms of the 10-year Treasury, which is really much more important to investors than what the Fed does, although the Fed action does impact the Treasuries to a degree. But I still believe that we're going to continue to see upward pressure on the Treasury rates. Now, I know that over the last week or so, Treasury rates have gone down a little bit, but, I can't tell you what moves it on a day-to-day basis, but I think over the longer term, we will see upward pressure on the Treasury rates as Treasury issuance increases once the budget is passed. And remember, they're going to have to get that resolved within the next month or so, or the federal government starts to run out of money. So the Senate is pushing back on the One Big Beautiful Bill Act, which is what is baking in all those new tax reductions or renewal of the 2017 Tax Cuts and Jobs Act, plus some extras. But it looks like the Senate's starting to push back on that a little bit. So we'll see what comes out of that reconciliation with the Senate. There's some pushback on a few items. Most notably, they really don't like the significant increase in the deficit being created by the bill that was passed by the House of Representatives. So we'll have to wait and see. But nonetheless, at some point, this will get passed and the government will issue a whole bunch of more treasuries, and that will put upward pressure on interest rates and treasury rates. At the same time, we're also still seeing a flow of capital, international capital, out of U.S. assets, out of U.S. treasuries, out of the U.S. dollar. We've seen the dollar weakening very aggressively in the last week as a byproduct of that. So again, that's another force that could put upward pressure on the treasury rates. You know, there's a debate on whether or not we see the Fed getting active if we were to go into a recession. That's an open debate. You know, part of the Fed's position, they haven't stated this, but this is consensus or opinions that I've heard. Let's call them opinions, that basically the Fed looks at it and says, look, a lot of this is driven by uncertainty and instability. And even if we lowered rates, I don't know that we would affect the recession risk one way or the other, because a lot of this is driven by sentiment as opposed to liquidity. So that's where I see those forces going. The other thing I think I have to touch on a little bit, and again, I'm trying to stay apolitical here, but you know, the clashes that have been happening in LA with the National Guard and the Marines going in, again, whether or not that is something that could be done is up for debate. It's being challenged by the state of California. But looking past that, you know, the flashpoint is what's happening with deportations and immigration. And so, you know, I really want to remind everybody that immigration is a important component of the U.S. economy, that a lot of our economic growth is fueled by adding workers, people, human resources into the U.S. economy. This has been the nature of the United States from its very beginning. We import labor. We always have. And so when we try to shut down the importation of labor, as we saw during the first Trump administration, and the current model is even more aggressive, but we saw immigration drop by about 40% during the previous Trump administration. And we also saw the labor shortage surge as a byproduct. Now, cause and effect, don't know. Coincidence, possibly. But we had a massive labor shortage in 2022 following the pandemic. But we had a significant reduction of labor coming into the country through immigration over the span of the prior Trump administration. And that immediately was followed by a significant labor shortage. So I think we need to consider, right? I'm not going to change the policy. I don't know, maybe somebody listening to this can change the policy, but I don't think so. Anyway, consider the sectors most impacted by the labor shortage, as noted by the share of the labor force in different fields that is non-native born. And that's led by farming. Okay, 37% of the farming jobs are filled by non-native born people. And that's legal in the US. That's an official number. Unofficially, I think it's far more. So farming gets hit. They have headwinds because of labor shortages. Construction, 34% of construction jobs are non-native. And again, I think that's the official number. I think the unofficial number is quite a bit higher than that. But regardless of what type of commercial real estate you're in, you will require tradespeople. You will need people who know how to put a roof on, people who know how to do drywall, people who know how to fix things, electricians, plumbers, and so on, framing of housing. And those tradespeople are significantly non-Native Americans. And as a result, I think that we will have shortages of construction and tradespeople going forward as a byproduct of the crackdown on illegal immigration, as well as the chilling effect this will have on legal immigration to the United States. Again, I think we'll see a downturn in legal immigration to the U.S. as a byproduct of this. Other areas that are going to be impacted include food services, especially, kitchen workers as well as servers and people who work in restaurants. I think we'll see it in hotels, and we will also see it in healthcare, particularly like certified nurses and certified nursing assistants and licensed practical nurses. The lower tier medical staff are going to be impacted by labor shortages. So that's something that we want to pay attention to. So we have a flashpoint in Los Angeles right now. And just setting that element aside, I think the broader immigration policy is worth considering. And there are sectors of employment, sectors of the economy that are going to face greater headwinds than others. And if you have needs of those services, then you need to bake that into your strategy. One of the other things I'm tracking right now is what's happening with the new tax bill, and it's passed the House. As I mentioned earlier, I think that it's running into some resistance with the Senate, but there are several provisions within the new tax bill that will be beneficial to commercial real estate. Most notably, that would be the accelerated depreciation. I think that's a big piece for investors. I think that that's probably the single most important element. Some of the other things, opportunity zones look like they'll get renewed. How well they're capitalized on, I don't know, because again, opportunity zones are very dependent upon construction and development. And even with the tax incentives, you have to offset the rising cost of construction labor, especially if we have labor shortages in the construction sector. You also have tariffs on a lot of the materials being used for construction. So if you recall, opportunity zones really require either new development or significant redevelopment in order to qualify for the opportunity fund and the opportunity zones out there. So that is one of those that I'm a little suspect exactly how much it's going to get used this time around, given where we're driving some of the underlying variables that would feed into that. Increased state and local tax deductions. The other one, a pass-through qualified business interest deduction increased. I think it was at 20 or 21%, now going to 23%. Basically, that's a write-off for small businesses, not corporations. LLCs would be benefited from that. So a lot of these could be positive. Section 179 equipment and software deduction doubled to $2.5 million. That's, again, it's going to be used if you have a value add investment, which I think is going to be a good opportunity. I think that set aside opportunity zones, I think some of the best investment options within the new proposed tax bill would be value add properties where you get that bonus depreciation on the asset and you get the bonus depreciation on up to $2.5 million of investment into the property to upgrade it. So value add, I think, is going to be a big winner under the new tax rules. So just shifting gears a little bit, talk about what's going on with commercial real estate. Honestly, I'm on this thing every week. And so I can't talk about, with a movement on a day-to-day basis. Essentially, commercial real estate continues to hum along, right? We're not seeing any big changes in apartments or retail or office or industrial or self-storage. Hotels have seen some softening. That's the one property type where you see the changes, on a daily basis. So we're seeing a downward pressure on demand for hotels, especially limited service hotels. I think the full service hotels are still supported by business travel, which hasn't cut back yet and probably won't unless we go into a full boat recession. So, but the limited service hotels, which cater much more to leisure travel by people who are less economically affluent, the hospitality, those limited service hotels are where you're seeing a little bit more softening in demand. Looking at retail, I think that there could be some softening consumption as well. I think in general, the populace, and you see this in consumer sentiment and consumer confidence levels, they've come back a little bit, but, or at least flattened out, but they're still running relatively weak compared to historical norms. And when that happens, we usually see a pullback in spending, especially on things that are non-necessities, things like travel, things like some types of retail. And so I think you could see some softening consumption in the retail side, but not within the necessity components. So for example, a retail center that has a grocery store, maybe a dentist, maybe an optician, maybe an urgent care clinic. I'm literally talking about the retail center right down the street from my house. That type of a retail center holds up just fine because that's necessity-based retail. Other tenants that will probably do okay include, unless we hit a real recession, I think fitness will hold its own. Activities will hold their own to a degree, depending on who their target consumer is. So those are going to do a little bit better, but really necessity-based commercial real estate has the strongest positioning. That includes healthcare real estate, medical office buildings, seniors housing will probably hold up pretty well. That took a long time to recover from the pandemic, but it's back on par with where it was. Housing will perform relatively well. And again, as I mentioned earlier, necessity retail. In terms of the transaction climate, it's still very choppy. There's caution in the wind, but there is still a lot of capital trying to be placed. And, for those who listen to me and buy into what I'm saying, if interest rates are going to rise, I think investors are better served to get the deals done today, whether you're a buyer or a seller. Right? If you're buying, you want to tap into the interest rates of today, not the ones of tomorrow. If you're a seller and you wait on those, you play around, you may end up chasing the market down and end up in a worse place than you are today. If we see a material rise of interest rates that holds over a longer term, it will eventually move the cap rates and the sales value of the real estate, setting aside significant gains in performance. But generally speaking, the real estate values lose some ground there. We've already seen it over the last few years. We've seen a repricing. Cap rates appear to have stabilized, at least for now. And we are seeing a better flow of transactions than what we have for the last couple of years. So that's about where we are. I do want to point out something, and it's really hard to track sales month to month for commercial real estate. People have a hard time getting their hands around this, but CoStar, which is the primary data vendor for property commercial real estate sales, they have a very manual process, and they only capture, a certain percentage of the transactions within 30 days, maybe 40, 50, possibly 60%, depending on the location, parts of the country. But it may take 60 or 90 days for CoStar to capture sales information. So you can't really look at it and say, oh, okay, here's what happened in May, here in the middle of June. You're really playing with data that goes back, a couple months. Probably to March is your most reliable data point at this point, the first quarter sales. And so right now, you don't have that good of a finger on the pulse I do have the advantage of being a member of Marks and Millichap, which helps more investors buy and sell commercial real estate than any other firm. So I can track our numbers, but I can't share them because they're not public information yet. So, but in a nutshell, the market as a whole appears to be more liquid today than it was a year ago. And so we're seeing a little bit more velocity out there. So that, kind of takes me through the climate that we're operating in and some of the key things that I'm watching there. I want to shift over to talk a little bit about the horizon, what we see happening over the course of the next 5 years or so. And this week, I sat down and I was thinking about this to myself. I said, okay, what if, the entire President Trump wish list comes through? What happens if all of the policies that he's enacting through executive orders or through Congress or through, ICE or whatever, basically all the things that we see happening today move through to a full execution? And so what happens with commercial real estate as an investment? I think from a broader economic standpoint, I think it becomes very bumpy, very choppy, a lot of uncertainty for an extended period. I think that other investment classes don't fare very well. I think that there will be a lot of volatility in the stock market as a byproduct if everything were to go through as stated at this point from the Trump administration. I think that the bond market will remain weak because international investment into U.S. treasuries will be slower. And I think that the buyer pool for U.S. treasuries will be weaker. And so as a result, the performance of treasuries as an investment, not so great. But I think real estate actually holds up really well. I mean, I'm biased. I'm in the industry. I live, eat, breathe commercial real estate every day. But, look, you get higher tariffs, right? Higher tariffs probably means higher inflation. But commercial real estate actually deals pretty well with higher inflation. You have properties that have pre-existing lease bumps built into the lease structure, 3% annual increases, something like that. Those hold out okay. You have apartments where you reset the lease rates every year. You have self-storage where you reset the lease rates every month. You have hotels that reset the lease rates every day. So higher tariffs set aside the impact on the goods and the consumer and the overall health of the economy. But from a pure operational standpoint for commercial real estate, higher tariffs don't really affect the real estate itself, but the byproduct of higher inflation means I think real estate outperforms most other asset classes in a higher inflation climate. I think the higher deficit and the loss of international investment into U.S. treasuries and the U.S. dollar results in higher interest rates. That could put upward pressure on cap rates over time. I think the spread remains relatively narrow between the cap rates and the 10-year treasury, meaning that, negative or slightly negative leverage position at the beginning, kind of first year negative leverage position continues in the current environment and under this model. I think the labor shortage becomes problematic, especially in the trades and hospitality and the lower tier medical services, as I mentioned. But I think that causes wage inflation in sectors of the economy. I think that we run into labor shortages. And for commercial real estate, I think that it's going to be most relevant in construction. That's a blessing and a curse, right? So as an operator, you're going to have a hard time finding a repair person. But you're also going to have to contend with much less new construction. So new supply risk is reduced by the labor shortage. It's also reduced by the tariffs, especially if the new lumber tariffs go into play, here in a few months. So we're also looking at potentially 50% tariffs on steel and aluminum, which also raises the cost of construction for developers. So new development slows down, and that risk is the risk of new supply as an operator and owner of property is reduced. I think that the other thing is the new tax laws. And I think that ultimately that's a win for commercial real estate. You have accelerated depreciation, a higher qualified business income, a business interest deduction. So the QBI will be beneficial for investors. So ultimately, and again, I'm biased, but ultimately, when I think about all of the places to put your capital, given a operating climate driven by the Trump administration's policies, assuming they continue and they don't stray too far from what's on the table today, commercial real estate, in my opinion, may be one of the best investment options available. And I just think it's going to be more durable, and I think it's going to offer better returns than most other assets. But again, that's just my opinion. So there you go. That's what I got for this week. I will, of course, be back next week on Sunday and every Sunday with whatever real estate insights pop into my head, quite frankly. And I want to thank all of you for joining the Horizon podcast. Have a great week.